calendars out. February 17th, February 18th, live trading, San Diego. We got the Lowe's Coronado. I mean, what else would you want? This event is limited to 50 people. Look at your calendar, clear it, make sure you show up. If you want to be a rebel, this is the place to be. You got to sign up for it now. Giddy up, baby.
Hey, welcome back, Market Rebels, and to all of our YouTubers out there. And it looks like we got another nice little close going. Last I checked, we were up about 1.25% on the SPY. Nice little gap, and we seem to have held most of that today. We took out that big red candle on Wednesday, so that's kind of the important thing to kind of maintain that 400 level. But it's been a while. It's been a couple of weeks. We had MLK last week, and we missed it. But I also got some bad news today. I've been doing this show since May of last year, 2022, and this is going to be our last show. But don't worry, we're going to still continue. A lot of the topics that I had here will be shifted over to Coach's Corner, which is the same time on Thursday. So I think it's just going to make things a lot smoother. So one of the topics that I wanted to talk about is really a series of topics. One of my favorite is on behavioral finance, which is really the psychology of investing, more about the bad mistakes that we make in decisions based on the way that we perceive things. I've got a whole bunch of them lined up. And again, I'll bring those over into Coach's Corner. But one that I wanted to talk about for today that I think is super, super critical is what's called the sunk cost trap. And the reason I like this is that we talk to so many people and in Q&A and in the live events, and I hear so many people making this mistake. And it's really one, if you want to polish up your tuning, this has got to go. So what is the sunk cost trap and why is it so devastating? Well, first of all, let's talk about sunk costs. What is a sunk cost? It's any part of an expense that is irretrievable. You're just not going to get it back. Hence, sunk. It's gone. And so the idea is that sunk costs should not be part of a future decision because it's just not going to make a difference. It has nothing to do with where we're going forward. It's stuff in the past. So you always have to remember that when you're making decisions, just part of decision theory is that they are always based on differences. If you're trying to separate the tie, you don't ask where are the similarities. So think of it, if you're at a car dealership and you say, I've got the base model car and then I've got the super duper deluxe sport model. What's your question to the salesman? Not what are the similarities? And he says, oh, they both have steering wheels. They both have four wheels. You go, okay, that helps me make my decision. The similarities don't help you break the ties. It's the differences. And that's really where the problems lie with the sunk cost trap or sunk cost fallacies. People tend to focus on things where they're similar, even though they don't think that they are. And that's what causes the problems. So here's a really good example that's done in a lot of behavioral finance books. It's really hard to beat this example. It just illustrates the point so well. So let's say that we have a Broadway ticket that costs $100. I know, where are you going to find a Broadway ticket for $100? But just play along for a moment. It doesn't matter. Pick whatever number you want. But we're going to look at two different scenarios. In the first one, you've bought the ticket up front. All right, so you've already got that. And you get down to the theater and you discover that you lost the ticket. So the first question that you have to answer is, do you buy another one? All right, so I want you to kind of answer that to yourself. And then if so, how much did the show cost? Now, most people would say, if they decided to buy another one, that the show cost them $200. And I'll say, well, the answer is easy. I had to pay $200 to get the ticket and to go. All right, well, hold that thought. Let's go over to the second scenario. And here you're going to buy the ticket at the show. You didn't buy it up front. So you go down to the show, but now you discover that you've lost $100 cash out of your wallet. So the same questions, do you buy a ticket? And if so, how much did the show cost? More people would be inclined to buy the ticket. And by the way, these were done by lots and lots of academic studies and surveying people. It's not just a hypothetical thing. They actually went out and surveyed people. More people would say that, yes, I would buy the ticket in this second case. And then when they were asked how much did the show cost, they said, well, it was $100. That's how much I paid for the ticket. You know, the fact that I lost cash, that was my fault. It had nothing to do with the show. So now here's the thing that you have to think about, though. In one case, people will say that they would go or buy the ticket again. And if they lost the actual ticket, they would usually say that they wouldn't. But here's the thing. If you decide to go to the show, you're out $100. One's in the form of a ticket, one's in the form of cash, but it's still $100. If you don't go, you're out $100. So what do you notice? There's similarities. This shouldn't enter the decision. It has nothing to do with what's going to happen forward. Whether you go or don't go, you're out $100. And yet, in so many cases, people will make the decision based on whether they lost the ticket or whether they lost the cash. The question is, do you want to go? It's not about here's how much I've lost or here's how much the ticket cost. Those are sunk costs. They should not enter the decision. But as this example shows, it does. It's fascinating. People will, in the second case, go to the show more often than not, and not in the first. So it's kind of interesting how we will make decisions based on something that is a sunk cost and what should be a similarity. So to change your trading perspective, which is really, remember what we're trying to do with Trading Tune-Up and Coach's Corner for that matter, how can we get around this? Well, here's a way that I think where people tend to fall into this trap the most. And that is, when should you sell? We've all heard that that's the big dividing line. It's not when you buy that matters, it's when you sell. Well, the thing that you should focus on, the one thing I would like you to take from today's show, is that it really should be a requirement or some requirements to prove you wrong. If the stock falls below support, for example, or maybe there's an FDA announcement that has now killed your initial premise. But there has to be some condition that convinces you that the initial outlook or your initial premise was wrong. It shouldn't be, oh, the stock has fallen from 100 to 95 and I'm down 5%. That's in the past. It doesn't matter. You're going to be down that $5 whether you decide to hold on or not. But people do, because they always reference it to the price where they purchased. Now it gets even worse or more exaggerated with options. So let's take a look at this example. Let's say that you have a long-term bullish view on ABC, not really a real ticker, but pick your stock, whatever you want to replace in here. And I ran these into a pricing model, so they're not just made up numbers. So I put ABC stock at 200, and we have a 1-year 165 call trading for 40. Now this by itself, a little side note, is what's called a stock replacement strategy, that we're 35 points in the money. It's mostly intrinsic value. It's going to behave far more like shares of stock than an option. And so it's a way to get some really good leverage and some high deltas and still basically control the movements in ABC stock. But now let's say the stock falls to 190 in 3 months. That's a 5% drop in the stock. We go into our pricing model to figure out the price of the option. But the first question here is, have you been proven wrong? Remember the initial premise. You have a long-term bullish outlook on ABC. Does this prove that you're wrong because you're down 5% in 3 months? Did you expect it to just do nothing but go up from the moment you bought it? That's really unrealistic. See, this has nothing to do with proving you wrong, but it's a sunk cost. It doesn't matter how we got here, but we're here. We're down 5%. But if we run this again into the pricing model, the 165 call falls from 40 to 30. It's down 25%. But that shouldn't come as a surprise because we paid 1/5 the price. Notice we paid 40 for the call and the stock was trading for 200. So yes, your returns are going to be magnified by a factor of 5. If the stock is down 5%, I can tell you right off the bat, we're going to be down 25% in the option. Shouldn't be a surprise. But both of these are $1,000 losses. And what happens, though, is that people will look at this. They'll say, well, if I bought the stock, I'd only be down 5% and I'll hold it. But if I bought the option, I'm down 25%, so I better cut it loose. Or whatever numbers you want to use. But I'm just trying to show you that they will make these decisions based on percentages. Percentages just show you the amount relative to a base. But look at them in terms of dollars. They are both $1,000 losses. But yet, in most cases, people will sell just because of the percentages. So how should you decide? Well, one thing to do to learn from this is to look at money in absolute terms, where $1 is a dollar, not whether it's 5% or 25%. So again, percentages compare to a range. They are useful, percentages are, but not always, not for making your trading decisions. So in this case, we were down $1,000. Why would we decide to hold? Because we're bullish. If we close it, what's the answer? We're still down 1,000. Why would we close it? Because we're bearish. But notice our decision doesn't change the fact that we're down $1,000. This has no bearing on our decision. Over on the right, it has everything to do with the decision. But how do traders do it? They don't pay attention to this, and they pay attention to that. And they just say, oh, I'm going to look at this because it's a 5% versus 25%. And it's just absolutely not the way to look at your trading decisions. So just kind of consider this. Remember that for any given stock price, there's an implied bell curve over its head. That dotted line is the current stock price. Don't expect that the stock price is only going to go up. Some of these times are going to just shoot straight out of the gates, right to the losing side. There's nothing you can do about those. Absolutely nothing you can do. Sometimes they're going to go up and just shoot to the moon for your calls. That's a good problem to have, and there's just nothing you can do. It just happened. Those aren't really the things that cause the difficult decisions. It's the stuff in the middle. So notice that, remember, if this is a current price, it's not always going to go up. It might do this, might drift off a little bit to the left here, meaning we're showing some temporary losses, but end up over here on the right at expiration or at some time in the future. It might do this. It might do this. There are millions of stock paths in here that start off on the left but end up in the right. And yes, there are some that start on the right and end up in the left. But the thing is that people create this artificial dividing line, and they'll say, if I'm down X percent, or if I'm down $500 or whatever, it's some arbitrary point to say that that must be the point to exit. But think about it. Wherever that black line is, that solid black line, that's where your new bell curve is. That curve has now shifted. It's now the current stock price. The losses are in the past. The decision to stay is because you are still bullish or because you haven't been proven wrong, not because you're down. That's got nothing to do with your decision, and yet it's the thing that everybody just hangs their hat on. I mean, does it really make sense that if we looked at thousands of paths like this, that they should all be exited at that exact moment in time? I mean, it makes absolutely no sense, but that's how most traders do it. And partly because traders or people in general are very risk averse. They don't like to see these losses. And so they think that they have to do something and take some action just because they've hit the magic point, whatever that may be. And that's fine. I'm not saying to have no risk management tools. I'm just saying it shouldn't be an imaginary made up point that's picked out of thin air, some percentage or some dollar amount. It should be something that has proven your initial premise wrong. And if you're leaving for other reasons and exiting the position, it's implicitly saying that you thought this position was only going to go up from the moment you bought it. That is completely unrealistic. If it hasn't broken your initial premise, it's probably worth staying in. Now, of course, as future topics, we could talk about what are some ways we could manage the risk or to reposition our risk in here. Those are different trading topics. But for right now, I just want people to understand that it really doesn't make a lot of sense to just pick this imaginary line as a point to exit, especially because they are just sunk costs. So the sunk cost trap is that traders often throw good money after bad, and they say, well, I don't want to waste the money already spent. And you have to just remember that sunk costs don't matter. So that's another form of a trap where people say, oh, I can't afford this loss. Let me just keep putting more and more into it. I don't want to waste the money that I've already spent. You haven't wasted it. It's gone. There is no, let me make up for it. That's a fallacy when people say, oh, we'll make up for those losses. Every trade stands on its own from the current stock prices. So don't let the sunk cost enter your decision. Instead, turn the corner, give your trades a little tune up there and realize it's more about Am I still bullish or bearish? Has my initial premise been proven wrong? And so I hope that gives you some things to think about. And for anybody who would like to have some consultations with our world-class coaches, which you'll see more of on Thursdays, here's a chance to get a free 30-minute one-on-one with one of our professional coaches. You've seen them. You've got Stu and Elliot and Scotty. It's a $100 value. So you can call that number right there. It's 888-809-8058. And they can really give you some great insights into different strategies and techniques that you never, ever would have considered. So not a bad deal for free. So give them a call. And so it is sad. I wish we could continue with this, but I promise you we're going to take all of these unused topics and we're going to move them over into Coach's Corner on Thursday so you can catch us there, and we'll still give you some really good, insightful information. I hope to see you then. So that's all I have for today, and we'll look for you on Thursday. Thanks so much.